Welcome to part 3 of AFM Tools to Pass, right? If you haven't watched my part 1 and 2, please do watch part 1 and 2. So part 3 we are discussing on the final section, section E. This video will talk about treasury and advanced risk management techniques, the currency risk and the interest rate risk management techniques. So let's start. First, let's start with the treasury function. You always need to know the theory part. So in this treasury function, which comes in chapter 15 in your textbook, is fully theory. There is no calculations. So you have to know theory of this. The theory which could be asked from risk management chapters are from this chapter, which is treasury function. You have to know what are the role of treasurer, right? Managing working capital, managing investment, managing finance, all these are treasury of functions of treasurer, right? Then next we need to know the advantages of separate treasury department. This question has been asked, right? Most of the time, what are the advantages of separate treasury department? Third, centralized versus decentralized cash management. And the treasury department as cost center or profit center, right? All this you can just read through once and it's easy to understand, so it's not much complicated, so I'm not wasting so much of time here to explain all this in details. It's self-explanatory. If you read it, you will understand. Let's go to the currency risk, the forex risk management, right? This itself is like a huge topic, right? You will be getting one section from this. That's 100% risk management. It could be a currency, it could be interest, or it could be combined in both in a 50 marks question. Mostly it comes in 25 marks questions in section B or C, right? And this, if you perfect this, right, this is one of the easiest section in AFM syllabus. If I have to tell, if I have to choose one, this is the easiest to score marks because it has a standard formula. Everything is standard form, is just the number keeps changing, that's it. The way you calculate futures, options, everything is same only, repeated, right? Even the questions has been asked in a similar way. If you see the questions from the past paper and see their trend, it's in a similar way they ask. They don't ask in a very different way, right? So let's start with, there are three types of risk: translation and transaction and economic risk, right? So the risk which we are hedging using the derivatives are transaction risk, right? We are studying transaction risk. So you need to know what is the difference. Economic risk is a long-term risk. Translation is from translating the financial statements, and transaction is when you're having an overseas supplier or customer and when you have to make a payment or foreign receipt, then transaction risk comes, right? So we are dealing with transaction risk. Next doubt is, the most important is how to know which rate to pick, the bid or the offer price. This is one of the key. You start with this. AFM has to be start with this. Which rate, bid rate or the offer rate? Which rate? There are two rates. That is the problem in currency. But in interest, it's fine because only one rate. But in currency, the problem confusion comes because there are two rates. Which rate to choose and how to know which rate to choose? So don't worry, I have made the work very simple for you. Right? It's very easy. Just you have to do this one thing. Always. Even in your financial management, right? See the currency on the right side. I have given an example also. Let's say 2 pounds is equal to $1. So just check the currency which is 1, right? On the right side, the base currency, right? The right side currency is known as also base currency. In this case, it is dollar. So that means we are dealing with only that currency. Only that currency means what? Which currency? Dollar currency. Only dollar we are dealing. We don't care about pounds. Whatever happens to pounds, it's not our issue. We are only dealing with dollar because dollar is on the right side. 2 pound is to $1. If it was the other way around, $2 equal to 1 pound, that time we are dealing with pounds. Now we are dealing with dollar, right? So we buy and sell in dollar only, right? And the rate which we have to pick is from the bank's point of view, not from our point of view. If we buy, right? If we buy, we have to see if we are buying, bank is selling to us, so we have to take the selling rate. If we are selling, bank is buying from us, so we have to take the buying rate. We always have to take the rate from the bank's point of view. I've clearly written there, that's why. so that you don't make this mistake again, right? And always you know that bank will be buying at a lower rate and selling at a higher rate, right? So 0.62 is the bid price and 0.65 is known as the offer price, right? Or so that's all you need to know how to do, right? Let's say uh, before I go to internal hedges, let's say that you have to make a foreign payment, right? You have to make, you are a dollar, like you are a US, your home is in US, you have to make a foreign payment, let's say in pounds. You have to pay in pounds. That's a foreign payment. What do you have to do to pay in pounds? You need to buy pounds, right? But when you go to the bank, you cannot deal in pounds. Why? It is quoted in dollars. Check the right side currency, it is in dollar. So that means you have to buy pounds, means you have to sell dollar. If you have to sell dollar, means bank is buying dollar from you. Bank will buy at which rate? 0.62 or 0.65? Bank will buy 0.62 because I told you bank always buys at lower rate and sells at higher rate. You have to interpret, you always have to do this thing. Always this thing has to be there in your mind. You don't have to write it, but it will be going in your mind. I buy, right? I'm buying this currency, that means I'm selling this currency, that means bank is buying from this currency. So you have to it has to be very fast in your mind. Only this will go, the cycle will go in your mind only. You're not writing it anywhere down, right? Once you do many practice on this, picking the rates, correct rate, then you will be mastered. Then automatically it will come to you. You will not waste so much of time trying to pick a rate, because whether it's forward, spot, anywhere, whenever you have to convert currency, you need to choose a rate. You have to pick a rate. So there you cannot go wrong, because if you convert using a wrong rate, then everything comes wrong, because you are recommending based on that, right? Everything is linked. Let's go to the second one. First, before we are going to forward options and futures, those all are there, but important thing is internal hedging techniques. We cannot forget about the internal hedging techniques. We always need to know. First, we always have to deal with internal hedging techniques. Even in the exam, whenever there are choice that we have, we can use internal hedging techniques. First we have to use internal hedging techniques, and second we have to go to the external hedging techniques. So the four internal hedging techniques are leading and lagging. Leading means you are paying early, lagging means you are delaying your payment to protect yourself against the currency risk movement. Next is invoicing in home currency. You don't want to deal with foreign currency, because if you keep everything in home currency, then whatever happens to the foreign currency, it will not impact your, right? Third, matching receipts and payments. If your receipt is in one currency, you try to make the payment also in that currency. And the fourth one is netting. Now netting can be of two types: bilateral and multilateral. Bilateral is one to one, multilateral is many, right? Many are there, so you should know how to net it off, right? Next, external hedging techniques. When we come to external hedging techniques, the first technique we start is with forward, because forward is the easiest way, easiest to start with, right? So forward rate, when you have to do, what do you have to do with forward rate? You just have to divide the hedging amount, right? The amount which you have to hedge, it will be given to you in the question. That amount you have to divide by the forward rate, or multiply the forward rate. It could be multiply also, because we don't know. It could be divide or multiply. I'm sorry, I forgot to put that, right? So you adjusted. So you change using that forward rate. Next is you have to know the features of forward. Any techniques which you study, internal or hedging, you always need to know what are the features of it, especially the external hedging techniques, whether it's forward, options, futures, swaps. You need to know the advantages, disadvantages, and the features. These three things I'm not writing all the time, but I keep telling that you need to know. At least one or two you need to know. At least one or two minimum. Next, features of forward. So features of forward, it's simple compared to other hedging techniques. It's a binding contract. The main feature of forward is it's a binding contract, right? And high default cost, yes. because it's not traded on exchange like futures or options, where credit risk is minimized. Here it's a high default because it's over the counter and it's not standard. Future forwards are not standard. It could be arranged for any amount, not like futures. Future, there's a standard futures. Let's say we have a future for $500,000. Sorry, 500,000 pounds. So we only can hedge 500,000 pounds or less than that. We cannot hedge more than 500,000. Let's say 500,000 and we only have to hedge 20. Let's say, not 20, let's say 100. Okay. 100,000 we have to hedge. So we cannot go and get a future for 100,000. We have to buy for 500,000 only. Even if our amount is 100,000 because it's standardized, right? Next is we also need this forward rate, by the way. Don't forget that forward rate also comes here in investment appraisal. It's not only for exchange rate. It's not only for risk management. Forward rate you have to use where? International net present value. Why international net present value? Because internationally you're selling, right? Investing abroad, selling internationally. Net present value when you take, then you have to convert to your home currency, right? The net present value has to be converted to your home currency. So how will you convert if you don't know the exchange rate? That exchange rate only you will predict using what? Using what? IRP, interest rate parity. The interest rates of the two countries will be given to you. Based on that, you can get and the spot rate will be given to you. So based on that for different years, right? It will be for different, let's say for 5 years cash flow. You need to convert to your home currency. Now you can using that spot rate and the the interest rate of the two countries, right? We all know the formula of interest rate parity. So using that formula, you can find the rates, forward rates for year 1, year 2, year 3, year 4, and convert to your home currency. That's why we need this interest rate parity, right? Next, money market hedging. So this is the second tool after forward rate. Now let's move to money market hedging, right? And money market hedging does not come for interest rate. Like other three comes forward, futures, and option, but money market only comes for currency. So money market hedging is not so much of work. The only thing you need to know is which currency to borrow at, which currency to invest in. That's the only issue with money market hedging. Other than that, money market hedging has nothing so much to do. So that also I've done for you. If it's a foreign payment, then borrow in home currency and deposit in foreign currency. This is a rule. You can write it down, you can take screenshot, right? If it's a foreign payment, borrow in home currency and deposit in foreign currency. You borrow in one currency, but you have to, when you borrow in one currency, right, you have to deposit in another currency. Your borrowing and your depositing currency cannot be same currency. Just remember that much, right? If you're having a problem of remembering two things, don't remember two things. Just remember for payment, what is it, right? For payment, I am borrowing in home currency. That's it. The rest you can fill up. The rest is like an fill in the blanks type, right? When it comes to deposit, you know what to do. It's the opposite. Reverse it. So if it's a foreign receipt, borrow in foreign currency, deposit in home currency. It's just the opposite of payment. If you know that much, you just have to learn this one line. If foreign payment, then borrow in home currency. This much sentence is enough. Rest all you can fill in the blanks. Next is need to convert currency. Rest. From borrowing to depositing, you need to, in between, you need to convert, right? You need to convert the currency. Convert to appropriate currency, right? It could be you are converting to home currency or foreign currency before depositing or investing, right? I'm sorry, actually it should not be before depositing or investing. It should be before depositing and borrowing, right? Next, don't forget to time apportion investing and borrowing rates. Yes, you must be given the borrowing and the investing rates. They are annual rates. You need to take for months. Let's say it's for 3 months you are hedging. So you have to take 3 months, the rate of the 3 months only. Let's say 12% is the annual rate. You have to take 3 month, right? 3 over 12 of 12%, which will be 3%. So that's how you have to time apportion. Don't forget it. Even if they don't write it's annual, the default is By default, it is annual only. Annual rates only they give. No one gives for month, right? They will be giving you the annual rate only, investing or borrowing rate. That time you have to take time apportionate. And final answer should always be in your home currency. This rule is for all the hedging techniques, whether under interest, whether under currency. Your final answer should always be in home currency. Then only you compare, and then only you recommend. This is the highest payment, this is the lowest payment. Let's go to the third type, which is futures. Now this is very interesting. Futures has lots of steps to do. Most of you get confused and you forget the step also in between, right? First of all, you remember. Later in between you forget and you mess it up. So it's okay. Here it's an easy process. I have done it step by step. I will show you. First, when you start future, right? Tick value. What is tick value? These are the terms you have to know when you're dealing in futures and options. Tick value is, I have written the formula also. Tick value, size of future contract into tick size. So your tick size and your size of future contract both will be given to you in the exam. So you don't have to worry. Even the tick value itself sometimes might be given to you. If it's not, then this is the way, right? Your future contract will be given to you that size. Let's say 62,500. And tick size, most of the time, it's 0.0001. Multiply and you get the tick value. You need the tick value because based on that tick value only you can find profit or loss on the future. So mind you that you need to calculate the tick value. Next, tick size and tick values always quoted in US dollars. This you have to remember. Even if you don't remember, it's fine because in the exam paper you will see that it's quoted in dollar, right? Just see that tick size, which is 0.0001, that is in dollar. Even the tick value, which is 6.25, that is also that answer is also in dollar. It will always be in dollar only. Next, how to find the closing future price. This is the area you need to work on future finding the closing future price. No worries, these are the step-by-step process. The first thing which you need to do is basis risk. You need to find out what is basis risk for finding the closing future price. You need to start with basis risk. What is basis risk? What is basis risk? Opening future price minus spot rate. That is your basis risk, right? Opening future price minus your spot rate. And also when you take that for the first one, opening future price minus spot rate, you have to take for the number of months it is unexpired, right? Let's say it is for let's say it's for 6 months, right? The duration is 6 months. Let's say not 6 months, 7 months, okay? From January to July, right? But you are taking January to July, right? You are taking a future on June. You are taking a June future. So from out of that 7 months, from January to July, out of that 7 months, you are taking future on June. So June to July, 1 month, right? That 1 month is unexpired. So 1 over 7 into future price minus spot rate. That will be your basis risk, right? It could be negative, it could be positive, your basis risk. It could be either way. If you are getting positive, write as positive. If you are getting negative, write it as negative. But don't interchange, because if you interchange, you will get confused. Interchange means don't write spot minus future, right? It will be future minus spot only. So your basis risk could be positive or negative. It doesn't matter, but it will be future minus spot. Even if future is less than spot, that means it will be negative. Second, opening future price. Opening future price is already given to you. Near the date it will be given, right? March future is this much, June future is this much. It will be given to you minus basis risk. Basis risk you have just calculated on your first one, top, right? So from that basis risk which you have calculated, an opening future price is already given to you, minus it, and you will get your closing future price. Next, your opening future price minus your closing future price, you can get a future profit or a loss, right? How you can get a future profit or a loss? This, to get a profit or a loss, now it depends on are you buying or selling? Are you buying a future or selling a future? let's say you are buying, right, a future. That means your opening position is buying. That means your opening future price is buying, your closing future price you are selling, right? Of course, we know that if you sell less than you buy, it's a loss. So that's how you are going to interpret it. You are going to see what is your opening position. Are you buying the future or selling the future? Based on that, you know what will be the closing position. So then you can know whether it's a profit or a loss. Next, future outcome. This is how you calculate the future outcome. I have given you the formula also, right? So future profit or loss, it could be profit or loss, multiply by the contract size. Contract size, let's say 62,500. It will be given to you. And number of contracts which you have to calculate, right? After you calculate the number of contracts, you multiply all this to get the total future outcome, right? Next, when you are learning futures, you need to know these terms, this 5 terms: initial margin, marking to market, maintenance margin, variation margin, margin call. Initial margin, you have to open up a margin account and deposit there some initial margin, right? What happens? This reduces the risk of default. Credit risk is reduced because of this, right? You cannot default now because you are depositing it. So it's a secure, they are securing, right? This is a more secure way than forward, because forward you can easily default, but not in initial margin, not in future, because initial margin you have to deposit it, right? Marking to market is, it keeps changing daily, right? Daily you are, if it's a profit, right, profit is added with your initial margin. If it's a loss, it will be deducted. So and this will keep changing daily, right? Daily profit and loss will be adjusted, and you will come to know your position daily, what is there in the margin account. And maintenance margin, what is maintenance margin? Maintenance margin is an amount, right? Let's say your initial margin is 1,000, and let's say your maintenance margin is 900. That means you are saying that if your account balance, your margin account balance falls below 900, then an additional payment is required there, right? You need to put an additional payment. Why? Because you want to make it up to 900. It cannot fall below 900. Again, to top it up with 900, you need to put some additional. Let's say because of the losses in the balance now is 700. What do you need to do? Again, you need to put 200 in the account to make it up to 900. So that is known as variation margin. And margin call is like a demand. If you're having a demand for an extra margin, that is known as margin call. So all these terms you need to know. They could ask you, because most of the time you have seen that they give future prices for the 3 days and tells what happens, right? To find the position of each day. So in this case, you need to know how the margin account works. Next, future market and spot market works opposite. This you need to know. That means if you are getting a profit in the future market, you are getting a loss in the spot. And if it's a loss in the future, you are getting a profit in the spot. In short, it is offset. The profit from one market and loss from one market, they're offsetted, right? It's becoming offset. How to deal with future questions. So these are the ways you need to know how you have to deal with future question. Number one, you cannot buy or sell US dollar future. This you need to know, right? You cannot deal in dollars in futures. You can deal in any other currency, but not future, because there is no future dollar, right? There's no dollar future. That's why you cannot buy and sell in dollar future. So what do you have to do? That for that also I have made a table. What do you have to do? Now, this is the first step. Whenever you're given a question of future and you have to calculate hedge using futures on the currency, this rule, by the way, is applicable for interest rate also. So when I go to interest rate risk management, there I'm not going to repeat this process. So make sure that you now itself you understand and you are very clear about it, because the steps will be repeated there. I'm not going to repeat it there, right? They are same. So choose which contract, March or June or September or December, it could be anything. You need to choose which contract. How will you choose contract? You see your day, your period, right? You need to see that first. So based on that, you will choose a future. Next, choose which type of contract, right? Buy or sell future. Third, calculate the number of contract. Amount to be hedged divided by contract size, right? Amount to be hedged will be given to you and the contract size will also be given to you. If both are in the same currency, by the way, one thing you have to take care is the amount to be hedged and the contract size has to be in same currency to be divided, otherwise you cannot divide it, right? Let's say amount to be hedged is in dollar, contract size is in pounds, you cannot divide. That time what you have to do is you have to convert it to what you have to convert to the contract size. Contract size is in pounds. That means the amount to be hedged is in dollar. You convert into pounds and then divide by contract size to get the number of contracts. That's how you have to do. Calculate the closing future price. Just before this, I have explained how to calculate closing future price. That you need to know, because if you don't find the closing future price, you will not know the profit or loss in the future. Calculate the future market outcome. Yes, we know how to calculate the future market outcome. This also I've explained to you. And next is calculate the net outcome. Net outcome is you take your spot market, it could be a payment or a receipt, add your future market profit or a loss, right? Let's say one scenario I'm giving is in the spot market, right? It's a payment, spot market payment, and in the future you're having a profit, right? So because of that profit in the future market, your payment, net payment will reduce. That means you're adding that profit with the loss, with the spot market payment, right? So that's how you're going to calculate your net outcome, because net outcome you have to calculate is very important. Based on your net outcome only you will compare with other hedging techniques, not your future market outcome. The thing which you are going to compare with other using forward option is your net outcome. Under all you need to calculate net outcome, especially under futures and options, not forward, because forward is just you take the forwarded and multiply or divide it and find it. But options and futures you have to find net outcome, because you're also dealing with the spot market, future, spot market and options. That's why net outcome comes there, right? Summary of future. So this is the summary of future. Features of future. These are some features. Contract is standard, right? Less default risk because we have margin account and only few currencies. Future does not deal with all currencies. We don't have in dollars. It only deals with few currencies. So if let's say some currencies which for which there are no future and you want to hedge it, you cannot hedge it using future. So that is a disadvantage, right? Make sure that you know the advantages and disadvantages. Now I have given the summary of all the four scenarios, right? Let's start with if it's a foreign currency payment in pounds. I have highlighted in red so that you can easily understand. If a payment in pound, you need to buy pound future. This is how you decide whether you buy future or sell future and which currency. Whenever you write which currency to, what you have to do in the contract, right? When you open up a hedge position in the future, first you decide the date, right? March or June or whatever. Then you need to say buy or sell future. But just buying or sell future is not enough. You need to name the currency. Which currency? Buy pound future, buy dollar future. Like this, you need to name. That's why I've highlighted in yellow, buy pound future. You cannot say buy future. Buy future, what future? Which currency? You need to name the currency. Pounds, dollar, yen, whatever currency it is there. So if the payment is in pounds, you need to buy pound future. If the payment is a receipt, sorry, if it's a foreign receipt, let's say yen, I have taken yen, I have taken a different currency so that you don't get confused with payment and receipt. If the receipt is in yen, you sell. So in short, payment you buy, receipt you sell that currency's future. Up to this much, it's easy. But the problem comes when you have to make a payment in dollar and when you have to make a receipt in dollar, then the problem comes. For that also I have a solution, right? If it's a foreign currency payment in dollar, what do you need to do? Okay, before you read that line to sell pound future, let's see what's happening to dollar. Okay, first always deal with the currency which you are paying or receiving, then only you know what's the opposite impact on the other currency. So let's say dollar, you are having dollar in hand and you need to pay dollar, right? You need to pay dollar means you need to buy dollar, right? But you cannot buy dollar because there is no dollar future. So what do you need to do? Let's say the foreign currency is pound in this case. So but buying dollar, you cannot buy dollar, but you can sell pounds. You cannot buy pounds in the future, so you can sell pound. There is an option to sell pound future, right? Pound future is there, so you have to sell that future. This is how you interpret, right? When it's a dollar payment, you sell the foreign currency future, and the other way around for the receipt. If it's a dollar receipt, you buy the yen future. Let's say yen is the foreign currency in this case, it could be any currency. But when it comes to dollar payment and receipt, you cannot buy and sell dollar future. That much you have to remember, right? And now let's go to options. So futures is over. Options you need to go. Options you need to be careful. And one thing, before you come to options, make sure that you are very thorough with your futures and you have understood properly how future works. Because if you don't understand future, mind you, you will struggle in options also. Because option and future are very, very similar. They even have the same contract size, same number of contracts. Most of the features are similar. The only difference in option is that premium is there. In options there's a premium, in future there is not a there's no premium. That is the difference. Other than that, the effect is same, right? So features of options. What are the features of options? One feature, great thing about option is the only hedging technique which can take advantage of adverse exchange rate movement also, and it can it can protect itself from advanced exchange rate movements, and also it can take the benefit of favorable interest rate or favorable exchange rate movements. Only option can do that. Other options is not. You can only protect yourself from a rise or increase, but you cannot take the benefit of it, benefit of a favorable exchange rate movements. But in options it is there. But because that benefit is there in option comes with a premium, high premium, right? Nothing comes free of cost. You pay premium, you get this benefit. That's why other hedging techniques you will see are less costly, right? So now let's start with few options. Okay, you need to buy or sell currency at exercise price, right? You buy or sell currency at which rate? Exercise price. Exercise price comes options, exercise price. Now OTC options versus exchange traded options, right? OTC is over the trade counter, right? So for options, it could be over the counter or exchange traded options, right? Mostly it's exchange traded options, but over the counter options is possible. They might give you in the exam, right? Mostly it is exchange traded options. Only options are exchange traded. But if over the trade options are given, that time dollar might be given to you, right? Dollar future or like that. That time it is possible, but not in exchange traded options of futures. So I have given an example also how options will look like, right? Dollar per pound options, and the contract size is 31 to 50 cents per pound. Why they have given cents per pound? This they have priced it, right? The option is priced cents per pound. That means the premiums they are talking about. Just go through this table. Your options in the exam will be given like this. call, put, and your strike price or exercise price, right? So exercise price, there are two exercise price, 1.5 and 1.6. They are the exercise price, and you can see call and put for August and September. And the prices which are 2.58, 2.14, this are your premium, and they are priced as cents per pound, right? That means 2.5 cents per pound. So how do you calculate the premium? Let's say you are taking an August call premium at an exercise price of 1.5 and the price is 2.58, but this is cents per pound, right? So always premium you have to divide by 100, right? Divide by 100 or you can multiply by 0.01. The result will be same only, right? So I prefer dividing by 100. Okay, so 2.58 divide by 100. Whatever the premium is, always divide by 100. So 2.58, because it is cents per pound, so you need to divide by 100. 2.58 divide by 100 multiply by what is the contract size? 31,250. Number of contract is not given here, so I have not taken it. But if it's given, then you have to multiply that also, the number of contract, to get the total premium. So we have got a premium here, $806.25, right? And this is a dollar, by the way. If your foreign currency payment and receipt is not dollar, like your home currency is something else, I have told you always your final answer has to be in your home currency. So this dollar, this premium again needs to be converted to home currency. How will you convert the dollar premium? To convert premium, you need to use which rate? Exercise price? No. You need to use opening spot rate. There also you need to choose offer price or the bid price. You need to pick. And premium is a payment, by the way. So based on that, you have to see which payment you have, which rate you are taking. Right? Always opening spot rate for converting premium. Because premium, irrespective of whether you pay or not, exercise or not, you have to pay the premium on the first day itself. That's why we are taking spot rate, not the exercise price. Put, right? What is put? This is an option to sell pause. I'm just giving an example. That's why I've written that put. It's not that put is more important than call. I've just written something to show you what it means, what this table means, right? This is an option to sell pounds. Put is always option to sell, call is option to buy. That we all know. In this case, because we are dealing with currency, which currency? This is in pounds. Why? Because the contract size, I have given a hint also. Look at the currency of the contract size. If the contract size in this case, this is pounds, because it is pound 31 to 50. That's why it's an option to sell pounds. If this contract size would have been given in different currency, let's say yen, then it's an option to sell yen, right? The put. And the call will be option to buy pounds. So that's how you read the table of currency options. Next, there is no dollar call or put options. The same way for future. The way we don't have dollar futures, we don't have dollar call or put options, even in options. US company will be paying pounds, okay? Paying pounds will buy pound call options, right? For US company, they want to pay in pounds. So what they have to do? They have to buy pound call options. US company receiving pound, what they have to do? They will buy pound put options, because receiving is put options. When you have to pay, it's a call option, right? But just see the first and the second line. It's always buy, whether call or put. So don't get confused. Buy call option, sell call option, buy put option, sell call option. There are no four options here. The things which we studied in options, there are only two. You either buy call options, or you either buy put options. No sell. We don't care about selling part. So don't go and write sell somewhere. It's always buy. Buy is fixed. The difference is it could be call or put, depending on whether it's a payment or a receipt. If it's a payment, call. Receipt, put. Right? But the situation will change if you're dealing in dollars. Now, the third situation. Look at the third situation. A UK company is paying dollar. You cannot go and buy dollar call options now. what do you need to do? You need to buy pound, not call, put options. It needs to be reversed. Dollar call option means pound put options, right? So you need to buy pound put options. And if company is receiving dollar, you are buying pound call options. Just knowing this four will solve your work, right? Whether call or put. In OTC, right? Over the counter option, dollar call or put might be available. So in the exam, don't come and tell me that I told that there is no dollar call or put options. I'm telling you under OTC it is available. It might be available, right? So they might give you dollar call or put. Then it will be easy for you. You can buy dollar call options. You can buy dollar put options. You don't have to convert to other currencies. But in exchange traded options, which we normally do, there you cannot use dollar. So make sure your currency, always check your currency with which you are dealing. And the last thing is you need to care is when a non-US company buy or sell US dollars using options, right? You need to buy or you need to sell US dollar using options. What do you need to do? First, dollar have to be converted into home currency. This you need to know. First, that dollar amount, right? This is a non-US customer. Let's say a UK company wants to sell in US dollar or buy US dollar, because he is paying in dollar, he's paying or maybe receiving in dollar. That time the dollar amount first need to be converted into home currency. And when you convert that into home currency, which currency you have to use? Exercise price has to be used for converting. Next, these are the steps for currency options. The way we have for futures, we have for options also. Most of the steps are similar to futures, right? So choose contract date, March, June, future, whatever it will be given to you, same as future. Second, call or put, same as future. In the future, we are saying whether we are buying the future or we are selling the future. Here we are saying whether it's a call or a put. Which exercise price it will be given to you, right? Sometimes what happens is they might give you 3 exercise price and then you need to, but still they will tell you which exercise price. So you don't have to worry about taking an exercise price, right? Most of the time they tell which exercise price. How many contracts? And how many contracts you work the same way you worked for future, right? And calculate premium. One more step is added, which is calculate premium. How do you calculate premium? I have written in bracket price in table. Whatever that table, there will be some price. Let's say 2.58. Multiply by 0.01, or you could divide by 100 also. I told you it's the same, but I always prefer dividing by 100. Anyway, the answer will be same. Multiply by the size of contract will be given to your number of contracts. After you get in step 4, you can use it and calculate the premium. Okay. Now that premium, I told you all these points I have covered. Premium will be converted at opening spot rate if it's not in the home currency. And 6, option outcome when exercising option, right? When of course you are getting an outcome under option when you exercise an option, right? There might be some cases where you don't exercise an option. You need to decide whether you will exercise the option or not, right? So when you exercise an option only, you will have an outcome under option. What happens when you don't exercise an option? In that time, that outcome will be under spot, right? It will not be, there will be no outcome, there will be no impact in the option. But yes, under spot market, there will be an impact. So net outcome, what is net outcome? Net outcome is equal to option outcome plus the spot market outcome. And also don't forget to take the premium, right? You need to take a premium. And then you need to add the premium and then you will be getting the net outcome. Net outcome again you need. For futures also you need, for options also you need net outcome. Otherwise you cannot compare. Finally, what you have to do is all the 3 hedging techniques, forward, futures, options, mostly these 3. Okay, they need to be compared and recommend the best under the scenario. Which one is the best under that scenario, whatever the scenario you are given. If payment, right? If payment, choose the one with the lowest payment, and for receipt choose the one with the highest receipt. But sometimes what happens is, let's say your futures and options are giving very marginal difference, right? The difference is very marginal. Let's say you are getting the lowest payment under future. Under forward also you are getting lowest, but it's slightly higher than future. So that time you can say that even if future is the lowest, but it's better to go with the forward because forward is simple and it's not standardized. So this is how you're going to interpret your answer, right? Now how will you interpret, how will you recommend? Based on the features, based on the advantages and disadvantages which you learned. This is why I always tell you, you need to learn the advantages and disadvantages of all the hedging techniques, at least one or two, so that you can discuss and come up with a solution, recommend, right? Advantages, disadvantages needs to be discussed. Now let's go to the currency swap. Currency swap is not so much in depth compared to interest rate swap, right? It's basically you are swapping the currency. You're exchanging the debt from one currency to another, right? Benefits and drawbacks you need to learn of the currency swap. And if there are multiple payments and receipts in the same currency, right? There, sometimes you might be seeing that you are not just hedging one payment or you're not hedging one receipt. There might be four payment or receipt. So if you can see that a payment and a receipt are in the same currency, maybe the dates are different, but they're in the same currency. What you can do is, first you can use internal hedging. What is that internal hedging? Like netting. You can net it off. You can take out the receipt, payment from the receipt, and only the net amount will be hedged using external, like forward, futures, and options. Right? So the net amount only be hedged. Don't go for that. By the way, you will be getting an additional mark if you do that. I'm not saying that you will not get marks if you go and you go to the external market and hedge, but that additional mark which you will get by netting it off, by hedging it internally, you will lose it. So don't lose the small marks here and there. You need to hedge first because internal hedging always comes before external, right? Wherever you can net off, net it. Take the difference and then hedge. Because what's the use of hedging the payment? It's in the same currency. You are hedging the payment also, receipt also, right? Two times, two different things. So it's becoming more costly. Better to hedge the net amount. To compare results under forward, futures, and options, all should be in the same currency. Always check your answer. Are they in that currency? Sometimes what happens is we forget at the end, right? We forget to convert to that currency, the currency which we want, our home currency. We just leave it in that foreign currency only. And some currency, the other, let's say forward is in dollar, future is in pounds. How will you compare? Sometimes you don't look at the currency, you just look at the amount and you start comparing. So don't do that, always check the currency. Now this is an example which I have written down for you to understand how a currency appreciation and depreciation affects, right? So let's say before $1 was equal to £1. Now $1 is equal to £2. What is happening? What is happening? Dollar is appreciating, dollar is strengthening in value, right? But pound is depreciating, it's weakening. This will have an impact on the foreign receipt or a foreign payment. If I ask this question now, you will not be able to tell me. But after this, what I'm going to show you, the working which I have done, you will be able to understand clearly and you will be very crystal clear. You will be able to understand how an appreciation and depreciation works. So I have written, okay, home. Let's say your home is UK. Home is UK. You have to pay in dollar. Let's say 500,000. Okay, this is just an example I have given here. You can take any amount. I always do this even under exam condition also. Let's say if I want to see whether it's increasing or decreasing is having impact, which currency is increasing, how it's having an impact, whether it's having a positive impact or a negative impact, I cannot just look at the currencies and tell. I'm not that good. I still need to do the small working. I always take 1 and 2, right? 1 and 2, right? Always work with a small number. Don't try to work with two big numbers. It's time consuming, right? Because the principle is same only, whatever number you use. So that's why for dollar I've taken 1 and pounds I've taken 1 and 2. Always, even under exam condition till date, if I need to do find what's happening to the currency, whether it's appreciating or whether it's having some negative impact. So I do this working like slightly somewhere. It's very fast. It doesn't take so much of time, maybe 1 minute or 2 minutes. I'll do it so that I know that now I'm confirmed that yes, this is happening. By just looking, I don't guess. I don't do that guessing work. I need to be very clear and very sure about writing an answer. That is my approach. That is my strategy for any exam I give. I need to be crystal clear before I do. I never do guesswork. Guesswork is not something which is for me. So don't leave it till the exam date and start guessing only. Right? Okay, so home is UK. That means you are paying foreign currency is dollar for you. Right? So before, okay, before the payment was how much? Before payment is 500,000, 500 pounds, right? That $500, if you $500,000, if you convert to pounds before, because 1 pound equal to $1, it will be 500,000 pounds. Okay, now how much will be the payment? $1 is 2 pounds. That means $500,000 will be 1 million pounds. What's happening from before to now? Twice expensive, right? The payment is becoming twice expensive in my currency. So what's happening? It's not good. This change is not good for me. I can clearly tell it's not good for my payment because my payment is becoming more expensive. Dollar is appreciating, pound is depreciating, right? So now if I have to write this sentence, that if the pound, here pound is depreciating, right? I can write this sentence, if pound is appreciating, it's better to take options because I can take advantage of favorable exchange rate movements. Now I can write that word, this sentence. Why? Because now I know the impact. Clearly I can see the impact, appreciation, depreciation. So now I can write. But before I do this working, how will I write? How will I write this sentence? That if pound appreciates, it's better to go for options because I can take advantage of favorable exchange rate movements. I cannot write this sentence, right? So I always do the small work. If you want, you can do it. If you don't want, that's fine. Interest rate risk hedging tools. Now we are done with currency risk. Let's move on to the interest rate hedging tools, right? So this is some few tools. You're only going to cover the last four. First is netting. Netting we have even under what? Even under currency risk we had netting, right? So netting is like you are hedging the net exposure. You are aggregating all the payments and receipts, assets and liabilities, and you are hedging only the net exposure. That is netting. Next is smoothing. What is smoothing? You are maintaining a balance between fixed and floating rate. This is interest rate. Forget about currency. Forget about currency. The best way, you know, what is the best way to learn a new topic? What happens is whenever we study a topic, continuously we have been studying a topic. Our mind is so fixed that when we go to a new topic also we started bringing our old theories, old principles and start applying there. So don't do this mistake. Always keep some gap, keep some 5 minutes or 10 minutes gap, right, before you start a new chapter or a new topic, before you jump to a new topic, because it gives you a clear mind to focus that chapter with a clear mind. New chapter, right? New topic. You need to unlearn what you have done in previous chapters to start learning new, because just now we have finished currency. So now when you come to interest rate, you will be working in that manner only, currency, currency, currency. So you need to unlearn what you have learned and learn these new things. This is the best way, but not everything. There are some things which you need to keep with you because you need to apply here as well. But smoothing, maintaining a balance between fixed and floating rate borrowing, right? Next is matching assets and liabilities to have a common interest rate. Pooling. What is pooling? Pooling, you are asking the bank to pool all the amounts of the subsidiaries, right, when considering interest level and overdraft limit. So this will reduce the interest payable. It will also stop the overdraft limits being breached. Okay. And also it allows the company to take better advantage of better rates of interest. But the important thing is the other four, this four, the now which I'm going to cover. FRA, the forward rate agreements. From here itself, we are going to cover forward rate agreements, FRA, interest rate futures, interest rate options, interest rate swap, right? There we had for currency, here we have for interest rate. So now let's start with FRA. What is FRA? FRA, there when we did forward, there was a rate, bid rate and an offer rate. Here it's not like that. Here this is how it will be quoted. Let's say there's a 3-month loan, okay, which is starting in 1 month's time. How will it be quoted? As 1V4. That V will be there, okay, only that 1 and 4, that number will keep changing, right? It's a 3-month loan. So whenever it's a 3-month loan, just check the difference from the lowest amount to the highest amount. That means 4 minus 1, difference is 3. That's how you know the duration. If let's say this was a 6-month loan, it would be 1V, let's say 1V7, 7 minus 1, 6, right? Starting in 1 month's time. That's why it's 1. If it's said that this is starting in 2 months time, it would be 2. Okay, let me change this question for you. 2 months loan starting in 3 months time. 2 months loan starting in 3 months time. Don't go and start put 2 there, because I told 2-month loan. Because the starting sentence starts with 2-month loan, don't go and put 2, right? 2-month loan starting in 2-month loan starting in 3 months time. So always check starting. After starting, what is there? If it says starting in 3 months time, that means it will be 3 V for how many month? The loan is for 2 months, so 3V5 FRA. That will be the rate. Because you might be because they might give you many rates and you have to pick one rate. You have to choose the correct rate. So that's why you need to know how to read the rates. And if you are a borrower, you will be concerned about what? Rise in interest rate, of course. And if you are a investor, you will be concerned about fall in interest rate. That we know, it's common sense. But still, I've written there. Okay. Let's say now I'm giving you a practical example how to apply FRA. Right? Let's say FRA is 5% and interest rate went up to 6% now. What happens? If the interest rate went up to 6%, the difference 1% will be paid by the bank to you. Right? Someone asked me this question: how will we know whether we have to pay the bank, or how do we know whether when we have to pay the bank, or whether bank will pay us or not? So the answer for that question is, when you are a borrower, you have to see your position as a borrower or investor. You are now a borrower, right? If your interest rate increases above that FRA rate, that time the bank will pay you the difference. If the interest rate goes down, that time you will pay the difference to the bank, right? In short, no matter what happens to the interest rate, whether it increases or decreases, you are paying at 5% only. It is fixed FRA, right? So if anything goes above 5%, let's say 6%, 1% compensation will be paid to you because it went above 5%. So again, it will be at 5% only, leveling at 5%. If the interest rate goes below 5%, let's say it goes to 4%, right? Again, you are paying at 5% only, right? You will be paid at 5%. How? Because now that 1% difference you have to pay to the bank. You have to pay 4% also because of that fall in FRA, and that 1% also you have to pay to the bank. So total you are paying 5% only. FRA will always be fixed at 5%, right? And also calculation for FRA. This is how, let's say a loan is for 10 million for 6 months. Then this is how it will be calculated. 10 million into 5%. Why 5%? FRA is 5%, right? 10 million amount of loan into FRA into the 6 month. So that's why 6 over 12. And this is how calculation goes. This you can take in money terms also, in percentage wise also, in interest rate forms also. I have taken in interest rate form, right? So FRA receipt, let's say if interest rate increases to 6%, I've already taken one scenario, the rising part. The decreasing part you can do it by yourself. I haven't done it. So if interest rate increases from 5 to 6, the difference, that 1% you will be getting from the bank, it's a receipt. That's why it's a receipt. And you are paying the loan at what? At 6% only. If interest rate increases to 6%, you are paying the 6%. But the net payment, because you are receiving 1, you are paying 6, the net payment is 5 only, right? And effective annual interest, you might be asked this question, right? If you are asked what is an effective interest, effective annual interest rate, so this is how you have to calculate. What was the amount out of the 10 million, right? It is 250,000, right? That interest, total interest 250,000. So that 250,000 over 10 million, always it's like this, multiply by 12 over 6, 12 over number of the loan. This will be fixed only, always it will be like this, into 12, right? 12 will be on the up, divided by duration of the loan. Here it is 6, that's why divide by 6 into 100. Again it is 5% only, it will be 5% because FR is 5%. So effective annual interest rate will also be at 5% only. Same way if you do for decrease, you still will get an effective interest rate at 5% only. You can try and do it. Let's go to interest rate future. When you have to price the interest rate future, right? This is how you have to price the future. You might not be given the price of the future directly. You might just be given the interest rate. Based on the interest rate itself, you can find the price. Sometimes it could be other way around. You might be given the price of the future but not the interest rate. But still, if one is given to you, the other you can find out. How? Because let's say if interest is 6%, contract price will be 100 minus that interest rate. That means it will be 94, 100 minus 6. This is how you price a future contract for interest rate future. Next, if it is borrowing, then contract to sell. If deposit, contract to buy. I've clearly written down. So you can just memorize from here itself. If it's borrowing, contract to sell. That means selling future. Deposit, you're buying the future. No, now you don't have to mention about currency, right? Most of you will be thinking which currency. We are not dealing, hello, we are not dealing with currency. We are dealing with interest rate. So no currency. Okay. How many contract? This also have given the formula in red color. Formula is in red color, right? It will always be this formula only. Because interest rate future, the way you calculate how many contracts under currency and under interest is slightly different. What is the different? The different is that fraction, loan period over length of contract. That proportion was not there in the currency future. It is here in the interest rate future. That's why I have included this formula. So how many contracts? Hedging amount. Let's say hedging amount was 10 million. Divide by contract size. It will be given to you. All these figures will be given to you. Hedging amount, contract size, loan period, length of contract. Okay. 10 million over 1 million into loan period was it was for 6 months. So 6 over 3. What is this 3? Length of contract. Which contract? Future contract. Future contract will always be for 3 months only. Right? Most of the time it is for 3 months only. I've never seen a future contract which will be more. It will be 3 only length of contract. So you're taking that future contract size. Don't go and take over 12 here. It's not over 12. It's not 6 over 12. 6 over the contract of the future. So it is 20 contracts. Okay. Now future outcome. That also I've written in red for you. As it is, you can memorize and write it in the exam. How you to calculate the future outcome. Receipt. Let's say the receipt under future you are getting 2.5%, right? This examples only I have taken. It can be any percentage. Size of contract was given is 1 million. So 2.5 into 1 into number of contract was 20 into now. Now it is not 6 over 12. This fraction again changes. Length of contract into 1 year. 1 year there are 12 months. You should take in months for 1 year. You cannot say 1. Or for 2 years you cannot say 2. If it was for 2 year, it would have been 24. But they will never ask for 2 year. It's always 1 year only. That means always 12 months. Right? And length of contract. Which contract? Not the loan period. Not that 6 months. Length of the future contract is 3. Out of that 1 year. So 3 over 12 into this you are getting 125,000 as future outcome. Right? Net outcome. Here also net outcome is important. This way we calculated net outcome under currency futures. Even for interest rate futures we need to calculate net outcome in options and futures. So here also I have written the formula. How you get the net outcome. Payment or a receipt in spot market plus receipt or a payment in future market. Just see the word. If it's a payment, right, in the spot, of course it will be a receipt in the future. And if it's a receipt in the spot, it will be a payment in the future. It will be opposite, right? So you add and the net outcome you will get. Calculation of basis risk and closing future price same as currency future. Please refer to currency future. I'm not repeating here. The old thing is there you are dealing in currency, here you are dealing in interest rate. The commodity is different, that's it. Everything else is same. The principle remains the same. Now let's go to interest rate options. For borrowing, buy put options. For investing, buy call options. Right? So investing call, borrowing put. But you are buying only, you are not selling any options. That much you remember. Buy. Premium. Option means you need to calculate premium. So this is how you calculate the premium. Memorize the formula. This formula is not there in your formula sheet. Premium, right? That amount, that premium from the table. Multiply by 0.01. Multiply by size of contract, which will be given to you. Number of contract, which you have to calculate. Multiply by length of contract divided by 12 months, right? Length of contract. What is the length of contract? The option you have to see. Next, rest all as same as currency options. Please refer. Caps, floors, and collars. You also need to know what is a cap, what is a floor, and what is a collar. Right? I'm not going to go in detail of this, but I'm just going to give a brief one-line definition for each. Go to. Okay, so let's start with caps. Okay, caps is for borrowers usually. Cap is like a ceiling. Just look at your ceiling up. That's like your, right? The highest. And your floor is down. That is at the lowest. So the borrower, they will be worried about that ceiling, that cap. And investor, the depositor, they will be worried about that floor, that interest rate going down. So borrower will be worried about interest rate going up. That's why cap, ceiling. Investor or depositor will be worried about interest rate going down. That's why floor, right? And collar, I will tell later because collar is little complicated, right? So ceiling, when you have a ceiling, these are like kind of options only, caps, floors, and collars, right? So caps, or you can say ceiling, anything, because it sets an interest rate ceiling, right? What you have to buy? You have to buy a put option, right? A borrower has to buy a put option. Please write it somewhere. I have mentioned this before in my video when I explained what is caps, flows and collars. If you want, you can refer to that video and see how I have done the working. I'm not going to do the detailed working here, but definition, yes, I can tell you. Cap says you are buying a put option, okay? As a borrower, you are seeing caps you are taking from the borrower's point of view. So buy a put option. Put option means what? Right to sell the future. Buy a put option, right to sell the future. So what you have to do is you have to see what happens when interest rate rises. What will you do when interest rate falls? So because you are a borrower, you are concerned about interest rate rises. So if interest rate increases, you will exercise an option. You will exercise. And if interest rate falls, you will not exercise the option. This much you have to know, right? If interest rate falls, you do not exercise the option. Does not matter whatever happens. You just pay the interest rate at that rate only, right? Let's say if your interest rate is at 7% and your interest rate falls to 6%, so you just pay interest rate at 6% and do not exercise the option. You don't even have to worry about buying and selling the future. You just pay interest at 6%, that's it. That reduced amount you pay, right? But if interest rate increases, let's say from 7 to 8%, then you have to exercise. Then you have to buy the put option, right? Because when you do that, there you will be getting a, because here you are having a loss of 1%. From 7 to 8%, interest rate is increasing. You're having a loss, but that loss will be offset because you're having a profit. Why are you having a profit? Because you're buying a put option, right, to sell the future, right? So anyway, the effective interest rate will be at 7% only. So the same technique you can apply for floors, but this time floor, they will be worried about if interest rate falls. So if interest rate falls, they will exercise the option. If it's for floors, the lenders or the investors will buy a call option. For caps, borrower will buy put option, lenders will buy call option for flows. That is all the difference. Rest all you know how to work out. You can check my video. And for callers you are doing two things together. You are buying a put and you are selling a call. Buying put, selling call. Just remember this much. Okay, and you need to know what happens when interest rate falls or rises. Or for all these three caps, flows and callers, you only need to know what happens when interest rate rises and falls. What are you going to do? Are you going to exercise? Are you not going to exercise? That much you need to know. But I predict that caps, flows and callers will not come, and even if they come, they will not come in so much depth, right? But it's good to know, right? Next we have delta hedging. Please go through delta hedging, just read, right? It's not so much of hard. There are so many other gamma, theta, rho, vega. There are 5 things which can affect the price of an option. But the important thing which you need to know is delta hedging, because only that will come for your exam. The other 4 will not come. So you don't need to worry about the other 4. Delta hedging, yes. Next, role of hedging for the firm. This question has been repeated as a theory question. I remember it was in March 2020, I guess for 8 marks. What is the role and why you should communicate the hedging policies to the other stakeholders and something like that. So, role of hedging for the firm. What are the benefits of hedging? What could be the risk of hedging? All these things you need to discuss here. Why firms need to hedge, right? So that's it for this video. We have successfully completed section E, but don't be so happy. One part we have missed, we didn't cover. That I will cover in my next video. That's why I didn't put it here, right? Because I need to show you live working on that. And it is currencies, interest rate swap. A very, very, I think I need to do working on that live. Live in a sense of I need to work and then I need to upload it. I just cannot enter some amounts and then show you because you will not be able to understand it. Interest rate swap needs good amount of time. So that's why I have put it for my last video. That will be my last part of this video. And also along with current interest rate swap, I'm going to end this video, right? The next video, I'm going to discuss what are the techniques you need to apply on the day of the exam right, in your paper when you get the paper. Time management, which topic to choose, which questions to start, how to read a question, all those things I'm going to cover. And I'm going to end that video. That will be my last video, last part, right? So I hope you like this video. Please don't forget to subscribe to my channel, like, comment, and share. And best of luck for your exam.